Good morning. It's Wall Street Beats. It's Monday, January 13th, 2025. We're 1 week away from a new president in the United States and a lot of change, a lot of uncertainty as to what happens beginning in 1 week. But in the meantime, I'm going to start by saying that all of our thoughts and prayers continue to be with all the people in California affected by the wildfires and the devastation there. But I'm going to turn it over to Charlie to start out this morning. I'll circle back later, some comments on energy. But Charlie, I think you had some comments with regard to these wildfires in California.
I do, and I'll end up there. I want to make two sort of macro observations very quickly. So this week we get the CPI and the PPI, and how those numbers come in is going to have some bearing on the rate structure. And rates right now is trumping pretty much everything in terms of how the market is trading. But the one observation I will make ahead of that is that for the first time since the Fed started cutting rates in September, the 2-year Treasury yield, which is around 4.39, 4.38, is trading above the Fed funds rate, which is around 4.33. The importance of that is that it suggests that the investor is no longer expecting further rate cuts by the Fed. The fact that the 2 years trading above the Fed funds rate. Whether they're expecting rate hikes is a different story, but at the very least, the marketplace is saying we no longer expect rate cuts. So will that change when we get the CPI and the PPI this week is what remains to be seen. So it's an important observation since rates are really the one factor that's driving the markets right now. Our own expectation, we've been saying this since December, is that the 10-year will move up towards 5%. We thought breaking through 4.5% would be a real negative for the markets. Around 5%, I might be willing to buy the TLT because I think a lot of things will have been discounted in the way, things trade. Anyway, let me move on to the next thing, macro thing. This Friday, we get housing starts. As anyone who's followed Wall Street Beats for a while knows, I've been on this kick that things that need to be financed are going to disappoint. And by things, homes, boats, RVs, motorcycles, cars, etc. I expect housing starts to be weak when they get reported on Friday. They're probably going to get lost in the sauce of all the earnings. But anyway, I do expect them to be weak. And that's important because that's the future cash flow of home builders is housing starts going to completions. The reason I expect it to be weak is that the inventory build for the home builders is quite high, and they need to move product off the lots, and it's going to require incentives, either mortgage buy downs or other types of incentives. So another data point that would suggest the home builders are going to continue to correct, particularly if rates trade higher. Finally, I want to just, as Bob mentioned, end up with some comments about California. And the wildfire situation in California is still very dynamic. So it's really hard to make strong statements about what impact those fires are going to have on the loan portfolios of the big banks. We start earnings season this Wednesday with the big banks like JP Morgan, Citigroup, Wells Fargo, Goldman Sachs reporting earnings. And so I'm hoping that there'll be some comments, but my guess is it's too early for them to quantify the potential impact. I wrote a report over the weekend where I tried to put some parameters about the potential losses for the banking industry, and we'll see, what comes out this week in terms of guidance. But let me back up and say, in general, the credit quality guidance or the credit quality metrics that are going to be reported for the fourth quarter this week are going to show very benign credit conditions. We'll have non-performing assets rising low to mid-single digits. Charge-off rates in the fourth quarter will be similar to the third quarter, which we call normalized levels. And reserve build will be minimal at worst, and we may even get some reserve reliefs. So in general, the credit quality metrics that we're going to see reported for the fourth quarter are going to be fairly benign. The question is the California fire situation, sort of a tipping point in conjunction with a higher rate environment for longer that will create stresses going forward. And we're starting to see signs of that outside of the banking industry. And I would make the argument that the bigger risks are outside the banking industry. The banking industry has actually done a fairly good job of managing their credit risks and building reserves ahead of any sort of downturn in economic activity. We've had, some of the private equity firms, some of the monoline consumer finance companies surfacing problems just here in the fourth quarter. So let me point out a few just to give you an example. Bread Financial, BFH, is a monoline credit card lender that really supports the subprime borrower, and they've raised their expected loss rates going forward. Then there is Ally Financial that last week announced a restructuring and a pullback in some of their lending and because they're seeing rising losses in mortgages, credit cards, and their core business of autos. Then there was a small regional bank, First Interstate Bank Systems, that pre-announced on Friday that they were going to take a $49 million charge-off on a distribution company. This company had been previously recognized as a non-performing asset, but had been given forbearance in an effort to help it get back on its feet. They had set up a $26 million reserve against this exposure, but in the end, it proved insufficient, and they're going to take a much bigger charge off than they ever anticipated. By the way, that process of forbearance is something that I think is playing out throughout the banking industry and outside the banking industry pretty aggressively. And I think it has understated some of the stresses in the system. The last thing I'll just mention very quickly is BlackRock also had a big write-off on an investment in one of their private credit, private equity portfolios last week. So we're seeing signs outside the banking system as well as inside the banking system that credit is not necessarily healthy, but the deterioration is, at least within the banking system, is occurring at a manageable pace. So my trade-off of this is to endorse something that Ben Bray has said earlier, and that is to buy into some sort of credit spread widening trade. I think if you had one trade that you had to put on this year and hold through the balance of the year and you couldn't take off, it would be that spread credit spread widening trade. Ben's preferred vehicle is ETF, I believe, called SJB is the symbol. But if you look at JNK or HYG, which are some of the junk bond ETFs, you can see that they had a sharp break towards the end of December, early January. They've come back a little bit, but spreads are incredibly tight relative to any sort of historical norms. And I still see credit deterioration occurring. So let me talk a little bit finish with some of the individual bank exposures in California. And this is something I wrote about over the weekend. Jen, if you can put up that first chart. I went back and first of all, you should be aware that no bank gives you their loan exposure in LA specifically. So we're having to guesstimate what sort of exposure banks have. But the four banks with big exposures in LA are Bank America, JP Morgan, US Bank Corp, and Wells Fargo. JP Morgan enhanced their exposure there when they bought First Republic, and US Bank Corp enhanced their exposure there when they bought Union Bank. What I can show you is how many branches they have in LA, how many branches they have in California, and then their total branch structure. And you can see that the LA branches as a percentage of total, the very far right-hand column, is roughly 5% of their total branch exposure. So the assumption I'm making in the exercise I did over the weekend and trying to understand what potential losses are in these loan portfolios was to say, okay, maybe LA loan exposures represent about 5% of total loan. So Jen, if we can go to the next table, loan exposures. Yeah, there are obviously different types of loan exposures. Credit cards, which are completely unsecured. Auto, which may be secured or have insurance. Residential mortgages, which typically does have insurance. Home equity loans. A multifamily exposure. Then there's CRE, commercial real estate, and C&I. And not every bank reports these numbers, so you're not getting a total apples to apples exposure here when you look at individual banks. But you can see that California, and by the way, this is total California, this is not LA, because they clearly are not giving you LA exposure, they're giving you total California exposure. You can see that it ranges anywhere from 10 to 30% of total loans. And then LA would be some sub-segment of that total exposure. And what I do in this next table is try and estimate what the loan losses will be in terms of the potential fallout. So I've estimated based on the previous slide that the Los Angeles is 5% of their total California exposure. And then I assume that the delinquencies that arise from this fire are going to be X percent. This is a table that I use to play around with the numbers, but in this particular table, I said, okay, let's assume 10% of the exposure goes delinquent. It could be as much as 40% goes delinquent, but I just started at a low number. And then you have to assume of those loans that go delinquent, what's your loss? And in this exercise, I assumed a loss given default of about 25%. It would not shock me if the loss given default is 40 or 50%, but I just wanted to start somewhere. And the bottom line is, if at this low end, what I would call the low end, losses are going to range from a low of $250 million at US Bancorp to as much as $750 million at JP Morgan. Relative to the total loan losses that I'm projecting for these banks in 2024, this is a very manageable number. It would increase their loan losses by roughly 10% on average. So not a problem. But if it increased the potential delinquencies to 30% and then assume a 50% loss given default, you can start talking about numbers like $750 million of losses at US Bancorp to $1 billion each at Bank of America or Wells Fargo, to as much as $2 billion at JP Morgan Chase. Depending on what assumptions you want to make, you can get to some numbers that are going to be impactful. The one thing I would conclude with is while the potential loss are going to impact earnings at some point here in 2025, it's unlikely they'll be big enough to impact capital on the balance sheet. In other words, I don't think we're going to see the kind of losses that banks experienced, let's say, in the residential bust of 2007, 2008, that diluted the capital accounts. So I think the balance sheets are fairly safe as the banks are well reserved, but the earnings are at risk from these fires. So why don't I stop there, Bob, and let you.
So add two questions. Do you think when the banks report earnings starting this week that they'll give some sort of guidance or commentary along the lines of what you outlined here as to what the potential losses could be?
I doubt it. They'll probably make broad, sweeping statements that it's manageable. And a lot depends on how they approach it. Clearly, forbearance is going to be given. For example, I have a friend in LA who lost his house and his truck had all his tools in it. And so his tools are gone. So he clearly has no truck, no tools, no business, and no cash flow to service his credit card and auto debt. And so he is probably going to be granted forbearance on the theory that there's going to be a period of rebuilding and that he's a contracted construction guy, that his business will pick up once the rebuilding of LA starts. So there's going to be some forbearance that will delay the recognition of losses, but the banks may reserve up front in anticipation that even with forbearance, some of these loans are going to go bad. So it's very difficult for me to pinpoint where the hits are going to be taken, how much the hits are going to be. What I can say with some degree of assurity is the bank's losses, whatever you thought the bank's losses were for 25, they're going to be some magnitude higher. But I'd be surprised if they put numbers around it. I think what they'll try and do is say, we can manage it, we're well reserved type of commentary.
Okay. And the other question you had on your initial comment, I wasn't aware that the 2-year Treasury had risen above the Fed funds rate, indicating the market saying we're not going to get any rate cuts this year. I think there's only one firm on the street, I think it's Bank of America, that's come out and said that they're now forecasting no rate cuts. Do the bank stocks reflect that? Is this good or bad for the bank stocks? And do they already reflect no rate cuts if that is the scenario?
Yeah, we've seen the banks have given back all of the rally that they had in November, which was a rally based on tax cuts, deregulation, a pickup in M&A and IPO activity. All of that has been given back. And the group that has been the weakest has been the regional banks. And they're the ones that would suffer the most from higher interest rates. One area of exposure that the regional banks have heavy use of is what we call cash flow interest rate swaps. And these swaps were put on in anticipation of rates going lower. And if rates don't go lower, then they're going to have huge unrealized losses in these cash flow interest rate swaps. And the regional banks have put these on in a very aggressive fashion. I've written about this and posted it on the Wall Street Beats website. And so I think the regional banks are viewed as the most vulnerable to an environment where rates remain elevated for longer. The other group that just last week started to see a little bit of weakness were the capital markets banks like Goldman Sachs. And that was on the heels of the Jefferies announcement. Jefferies announced very robust revenues in investment banking and trading. And so we're expecting that on Wednesday and Thursday, we'll see similar reports from Goldman Sachs and Morgan Stanley. The problem was Jefferies reported a disappointing bottom line. So they beat on revenues, but missed on EPS. And the reason they missed on EPS is because they had to accrue large bonuses for these investment bankers. And the analysts hadn't adjusted their models for the compensation relative to the robust revenues. And so what I want to be careful about is Jefferies being a sort of a second tier investment bank. They would hate it if I said that, but it's not a bulge bracket firm yet. They had gone on a hiring spree of hiring huge, big ticket guys out of the bulge bracket firms. Same with Evercore, Moelis, Houlihan Lokey. All these guys have been trying to beef up their talent because they've been expecting a big M&A IPO wave. But they're now faced with having to pay these guys to keep them. The bulge bracket firms may not have had to do the same sort of upgrade of talent and therefore may not face the same compensation costs, but they are going to have to accrue higher bonuses. And so we'll see how that plays out. But we did see some weakness in Goldman Sachs and Morgan Stanley after that Jefferies report last week. Sorry, I apologize.
No, that's a lot of information, good information. Thanks, Charlie. Just to make a quick comment on energy, we'll be consumed with bank earnings here over the next week or two, and then we'll start getting earnings from the energy sector after that. The one company that did come out last week, first company to come out and give guidance in their budget for 2025 was Canadian Natural Resources, C&Q, which was one of our favorite oil-focused names. And it was no surprise. It was pretty much in line as a neutral reaction in what they came out with. And they're going to see production growth of around 12% this year. But what I point out is all that growth is coming from pretty much acquisitions. So the organic growth is going to be flat to maybe 1 or 2%. And they've made some very smart acquisitions that's going to drive that 10 to 12% total production growth. The other thing I'd point out is that while they're looking at natural gas production being up 14%, and again, that's mostly from acquisitions, all that natural gas production is coming from liquids-rich areas. So that natural gas is getting an extra uplift from the liquids that they then strip out of the natural gas. They're not producing any pure natural gas wells otherwise given the gas price environment. So again, another company that's holding back from ramping up due to economics, their pure natural gas production. But the last thing I'd say with C&Q is they still have on deck a very aggressive share repurchase program. So they expect that per share growth to be even higher as they allocate 60% of free cash flow after dividends to shareholders, which I think will primarily be from, again, share repurchases. There'll be a dividend increase coming at some point this year. They pointed out that they've increased their dividend every year for the past 25 years. And last year, they increased it twice. Do we get a dividend increase here in a few weeks when they report fourth quarter earnings? Maybe. Typically, that's when they do increase the dividend, but they last increased the dividend at the end of October when they reported third quarter earnings. So maybe we get one now, maybe it comes later in the year, but we will get a dividend increase at some point this year in a stock that's already yielding close to 5% on the dividend, which I view as very safe. As oil prices continue to be strong here and hold in, C&Q continues to be one of our top picks on the oil side. So just wanted to throw that out. We'll have more commentary as other companies come out with budgets and guidance for the year, but that was the first company to really come out with their budget and guidance, which was pretty much in line, no surprises.
Hey, Bob. On the WTI crude, where we are 78, pushing 78 today, there's been some talk about this whole move has been primarily a short squeeze because people were caught offside. Is there any way from Commitment of Traders report or other data to know whether this is strictly a short squeeze? Because that obviously is going to factor into inflation expectations at some going forward.
Yeah, there's a little bit of a short squeeze, but I think a lot of it's just people turning more bullish on crude oil. As we went into the end of last year, a lot of the verbiage and reports were very pessimistic and negative and just giving how China was going and all that. But what we've seen in particular is U.S. crude oil inventories continue to get drawn down. And right now, part of the strength in oil is just this very cold weather, which, again, a lot of homes and businesses in the Northeast still use heating oil. So along with natural gas getting an uplift, oil's gotten a little bit of an uplift from this cold weather we're seeing here in the Northeast. Part of the headlines this morning was that the U.S. put on additional sanctions onto Russia. So again, it's trying to limit their exports of crude oil. And China still is a wild card here, but there's a little bit of short covering, but I think a lot of it is just, one, the inventory levels in the U.S. being drawn down and people getting nervous about that. And we'll see what goes on here. And you and I were talking before. It's interesting because when Trump takes office in 1 week, the big thing he wants to target is reducing inflation. And the biggest up factor on inflation right now is energy prices. This is not good for Trump's agenda in reducing inflation. So we'll have to see how this all plays out. But yeah, it's a little short covering, but I think a lot of it is people just turning around their view here, just given where we're seeing inventories and everything play out here. So it's worth keeping an eye. We're still constructive on the outlook for crude oil prices this year.
And can you give us an update on where OPEC Plus is with their containment of oil production, and where are we in refilling the special petroleum reserve as well?
Yeah, the strategic petroleum reserve is still pretty low. And so that's another factor. We need to refill that. Whether Trump decides to take that on at some point, we'll see, because that's certainly refilling the SPR is not going to bring oil prices down. And in the prior administration, it released a lot of oil trying to keep prices low. They recently started to add some oil to the SPR, but it's still way below where it had previously been. And then what was the other part of your question there besides the SPR?
Where OPEC Plus is in terms
OPEC
of...
Plus, yeah. So they still have on the docket to begin increasing some of their production at the end of March. Now, we'll see whether that happens or not. It really depends on where oil prices are, because they've pushed that out twice now by 3 months each time, just because oil prices were down in the 60s, mid to low 60s. So now that oil's up here 75, 80, and what their outlook is at the end of March will dictate whether or not they actually followed through and beginning to increase or put some of that oil back in the market at the end of March, or whether they push that out another 3 months. But our view has always been that OPEC likes the price up here around $70 to $80 a barrel. And so we'll see what they see in their forecasts and where prices are and inventories around the globe, what's going on with China, as to whether they follow through and actually now putting some of that oil back into the market. But I don't think that they definitely don't want to see oil prices below $70 a barrel, in my opinion.
And finally, just to conclude, you obviously like CNQ. There are 2 or 3 other favorite names you've been buying.
Yeah. On the oil side, Diamondback and EOG. And EOG presented at the Goldman's conference last week. They're pretty good at their canned response to questions, so you really couldn't glean anything incrementally new from them. But that's one of the names I expect to have a good quarter, and a name that I continue. Diamondback's been a little bit weaker here, but it's the other name that I'd be looking to buy. So if you're looking at the oil side of things, CNQ, EOG, Diamondback.
Great.
So I know you own a couple of those, Charlie. So
I do. I restructured a lot of my portfolio in the fourth quarter towards energy.
Yeah, I think that'll be a good move. I think that'll pay off this year. So
in general, I'll tell you, my bias is that anything that you drop on your foot and hurts is what I want to own. So a barrel of oil, if I drop that on my foot, it's going to hurt. A coil of copper, it's going to hurt. A bar of gold is going to hurt. That's what I've been reorganizing my portfolio towards, those types of hard assets.
Yep, I understand it. So, well, good. Thanks everybody for dialing in this morning. We hope you enjoyed the show, and we'll be back again tomorrow morning.
Thanks, Bob.
Thank you. That was good, Charlie. A lot of good information. I always enjoy hearing everything.